What's up, you guys? Selweb here for OneGlanceTrader.com, and in this video I'll be walking you guys through a step-by-step example on how to trade the wheel strategy. Now, for those of you who watched my previous video on the basics of buying options and selling options, you guys will know that the wheel strategy is an option selling strategy and is my preferred approach to trading options. And the reason why that is I like to sell options to collect that premium. And I talked about it enough inside the last video about even if the share price goes up, down, or sideways, you can still collect income utilizing selling premiums and utilizing the wheel strategy approach to kind of give you a framework into selling options. And like I said, in this video, I'll be going through a very thorough step-by-step guide and walking you guys through the process in terms of how each steps of the actual strategy works. But at a very high level, as I talked about at the back end of the last video, in step one is that you sell puts. So you sell puts below the current share price in the hopes that you do not get assigned the shares. And what we're talking about here is when you sell a put or sell an option, you're basically writing that if the price of the stock reaches that strike price or below, you will buy 100 shares of the underlying. So the aim is that you have to have, if you've got a cash account, you have to have the collateral to hand to be able to cover that in case you get assigned the shares. But the aim is to put your strike price way below the current share price so that you are collecting premium and the likelihood of being assigned the shares is very low. Step two is obviously assignment if that does happen. So if the share price does fall below or at your strike price at the date of the expiration, you will be assigned 100 shares of the underlying. So then you move on then to step three, which is instead of selling puts, you sell calls against that. And what calls basically are is that I am willing to sell 100 shares of X at this price at this date of expiration. So now you own 100 shares. You now sell a call at your cost basis or slightly above your cost basis if you want to get some appreciation in the stock in terms of collecting more premium and potentially more appreciation if that's what you decide to do. And in this example where unlike selling puts, you're trying to be way out the money in terms of way below the current price. What you're trying to do is sell calls either at your cost basis or just slightly above because you want to dump the shares and step four, which is to get assigned, get that collateral back, and then move on to the step one again and selling puts on the same stock or another stock. And so that's the basic framework. And now we're going to go into each one of these four steps in greater detail with a live example that I've done. And as I mentioned in the last video, you firstly want to look at a stock. When you look at the stock and you look at the premiums that it's offering, yes, you can get blinded by these kind of premiums like these meme stocks like AMC and GameStop and things like that. But do you really want to own 100 shares of AMC and GameStop? That's everyone's personal preference. So you got to make sure you want to do it on a stock that you want to own. So back in February, March time, I was interested in a company called RIOT Blockchain. So ticker symbol RIOT, and it's a Bitcoin mining company in America. And there's two reasons why I like this stock. One, I am long-term bullish on Bitcoin. So, I own Bitcoin. I'm averaging down on Bitcoin. And, over the long term, Bitcoin is going to go, in wherever it's going to go. And what you normally see is when you show Bitcoin's chart and Riot's chart, they kind of mimic each other. So when Bitcoin goes up, Riot goes up. When Bitcoin goes down, Riot goes down. And Bitcoin took a bit of a sell-off at the back end of February, and it did, and so did Riot. Riot dipped from its all-time highs of 79.50. And at the time of looking at this stock, the current price of Riot was at $67. Now, so what I did is that I sold a put one contract at the $50 strike price. So what that basically means is that I am willing to buy 100 shares of Riot at a particular expiration date, and in this case, the 26th of February expiry, which was a week expiry, and I collected $133 premium. So I had to put 5 grand of my own money, which is the strike price, obviously times by 100, so therefore you've got $5,000 collateral, and if the share price by February the 26th is at $50 or below, that 5 grand will be used to buy 100 shares of Riot. And so when you look at it from this perspective, and we'll go into how to select the right strike price and the different mechanics behind that inside the next options trading video. So I'm not going to go into in the money puts and out the money puts and deltas and all these different things that you might have heard of in this video. But if you look at it from a percentage return perspective, that is 2.6% return in 5 days, right? And the worst case is I own the stock at $50, which I am happy to own. And what I've got here is just a screenshot of my statement, so you can kind of see how it looks on, broker platforms. I use Interactive Brokers as my platform. So it's saying the ticker symbol Riot, the 26th of February 2021 expiration, selling the $50 strike, and the P stands for put. So I placed it on the Monday, which is the 22nd, expiring on the 25th, -1 because I'm selling a contract at $1.33 per share, which then works out to be total, because there's 100 shares of $133. So that $133 has been directly put into not into my bank account, but my brokerage account, which I can use to go buy shares in Riot if I really want, withdraw it, and go pay for my phone bill or whatever it is. That money is mine, and no one can take that money away from me. And obviously, you got to pay tax on it. But other than that, that $133 pre-tax is yours. And if you think about it, here is I'm 25% away from the current price. Now, you'll see in the future slides that Riot, it does move a lot, which is why you can get such good premiums. To get $133 premium in a week is a quite good premium to actually be collecting. But there's 3 things that can happen here. Is that the current price is 67. In a week's time, Riot could trade above 67. So therefore, the option will expire worthless. My $5,000 will come back to me, and so will my $133. What could happen is the price could stay within 67, 68 dollars and stay flat. And again, the option will expire worthless. I'll get my $5,000 back. Now, this is where the price can even go down, and you can still quote unquote win, because as long as the price doesn't go to $50, you still win. So the price could close at $51 and the option will still expire worthless because it's not hit the actual strike price. So that is the trade that I put on. And as you would probably imagine, what happened is that I got assigned the share. So as you can see here, on the February 26th, Riot closed at $43.74. So what does that mean in terms of a P&L perspective? So my realized P&L is $133, which is the premium that I gained. But as you can see here, is that Riot actually dropped way below my strike price. So as we remember, I got assigned the shares, and I have to buy the shares at 50. Even though it dropped to 43. And that's the risk that you're taking, which is why option sellers sell premium, and also which is why you want to do it on a stock that you want to own. So now I have an unrealized loss of $626. And the way that's calculated is your strike price minus the closing price, which will then give you your per share loss. Then obviously you own 100 shares of the underlying, so you times it by 100. So it was $6.26 is the gap between 50 and 43.74 times by 100. So I've got an unrealized loss of 626. But that's fine. From my perspective, I'm not selling my shares, so it's not a realized loss for me. At the moment, it's just sitting there as an unrealized loss. And $5,000 is, into the share. I can't use that $5,000 anywhere else unless I decide to sell the shares. So now what we do now is we move on to step 3, which is to sell calls at or above your cost basis. So now my cost basis, my break-even point is $50, and the current price is $43.74. So if the price rises to 50 or above, I'm now in a realized gain because the stock has appreciated in value above the price that I purchased it at. So what I did is, as you remember, as I talked about, I don't want to be selling calls way above my cost basis because I want to get rid of the shares as quick as I possibly can. So I can either sell it at 50 or slightly above 50. And what I decided to do in this instance is sell the shares at $51. And I netted a premium of $358 premium. So again, this is a week-long option expiring on March the 5th. I placed it on the 1st of March, and you can see here I sold a call at $3.58 per share, and my proceeds times by 100 is $358. So I've netted another $358 passive income coming into my brokerage account while I'm holding shares that are currently at a loss. Now, for me, that changed everything in terms of why I love the wheel strategy and why you want to do it on stocks that you want to own. Because I truly believe that RIOT will be above that price, sooner rather than later. It may not be tomorrow, it may not be there. And if you guys look at RIOT now, you guys will know RIOT is actually below 43.74 at the time of recording. But I'm recording this in June, where this was back in February, March time. So, I still think that RIOT will still go into the back to its all-time highs relatively soon once Bitcoin starts picking up. So that's what I did, and guess what? RIOT dropped further at the date of expiration. So what does that mean? So that means that the option expired worthless. I still have my 100 shares in RIOT at a cost basis of $50. So what does that mean now for my realized and unrealized P&L? So my realized P&L is now gone up because I've got the 133 plus the 300 odd, whatever it was, for selling that covered call. So therefore, my realized P&L is now 491, but my unrealized P&L has grown bigger because it's dropped further away from my $50 cost basis. Again, which I'm fine. Again, if having unrealized losses is a challenge to some people, options in the wheel strategy probably isn't the best. But that is why I don't want an unrealized loss of 1,000 on AMC or GameStop, because then I'll be worried about, is it ever going to recover? But I'm a big believer in RIOT, which again, back to step one, is you're willing to hold on to the shares. So what happened then is that I sold another covered call at the same strike price of 51. I did it on March the 8th, expiring on the 19th. Expires on 19th of March. This was a slightly longer time frame in terms of expiry. And the reason why I did that is because I couldn't collect a lot of premium back at the 50 or 51 strike. So I had to make the expiry a bit longer to get to be able to collect enough premium that I was happy with. So this one I think is a 2-week expiry, and I've netted $267, and you can see that here of $2.67 per share, which makes you $267. So now I've made an additional $267 on this on holding the stock that is continuing to go down. So at the date of expiration, the close price ended up for RIOT at $60.65. Now, so what happened there is even though it closed at $60.65, I wrote a contract to say that I'm willing to sell 100 shares of RIOT at $51 per share. So therefore, my shares got taken away at $51. So I lost out on all that appreciation, like $1,000 odd of appreciation between the 51 and the 60 close price. But I'm comfortable with that. As an option seller and in the trying to gain income from premium, I don't get too emotionally attached that I lost out on $1,000 of appreciation, because I'm not in the game for appreciation. I'm in the game for premium. So how does all of this now affect my overall P&L now? So my realized P&L is a total of $858, of which $758 came from premium. The first one came from the first put I sold, which I got assigned. The next one was from 2 covered calls, one that expired worthless, and then the last one, which is this one, where I got assigned. I also made $100 in appreciation. So obviously my cost basis was 50 and my strike price was 51. Minusing those two numbers was $1 per share. I own 100 shares of Riot, so therefore times by 100 gives me $100. So I made a total of $858. My unrealized P&L is back to zero because I've now got back my $5,000 of collateral. And if we then look at that of the premium received plus appreciation divided by the original collateral that I put into this trade or this cycle of trades, it's a total of 17.16% in just under about a month between the end of February to kind of the end of March. 17.16% return in a month. Now, this is what kind of blew me away when I was doing this kind of process and this strategy. The returns are insane, and you can compound an account if you got 50, 60k in terms of this. And right, it's a bit of a different example because it's a very volatile stock and they've got higher premiums. And as we go into this journey a lot more, you'll start seeing live trades, and I'll do analysis of stocks that I'm looking at, that I'm invested in, so you guys can get your views and your opinions on it. But I just wanted to kind of show you the power of the wheel strategy steps 1 to 4. So I really hope that kind of makes sense. Comment down below. I'll try to answer them as best as I can, and some of the questions that I'm getting are coming up in future videos. So depending on when you're watching this, the next video is all about strike prices and what strike prices to do when trading or selling options or trading the wheel strategy. If you're watching this kind of live, I will put two things on there. One around support and resistance, and the second on which is the basics option trading video about buying options and selling options and why I sell options for income. So I really hope you enjoyed this video. Please like, please subscribe, and I shall see you guys in the next video.